when investments go down, tax savings go up. Right now, stocks are down 20%. Cryptocurrencies like Bitcoin are down 55%, Ethereum down 70%. And real estate, depending on who you listen to, it might be next on the list. So look, instead of ringing the bell, sounding the alarm, and panicking, I want to help you take advantage of a tax loophole that actually allows you to use your investment losses to save on taxes. If you are an investor right now and you are experiencing some losses somewhere in your portfolio, then stick around to learn how you can use these losses to benefit you on your next tax return. My name is Sherman the CPA, and I am going to walk you through this tax loophole step by step. And all I ask for in return is that you smash the thumbs up button below to help this video reach more investors just like yourself. All right, so the name of this tax strategy is called tax loss harvesting. Tax loss harvesting is when you sell securities like stocks or assets like real estate with unrealized losses. Now, this sounds way more technical than what it actually is, so let's break this all the way down. Let's start with securities. Securities are basically publicly traded investments like stocks, bonds, cryptocurrency, options, index funds, mutual funds, or publicly traded real estate investments. But wait, that's not it. You can also use this strategy with any assets you own, like your primary residence, rental properties, cars, boats, equipment, or any tangible asset that you can physically touch or put your hands on. So if you buy securities or assets and the market price right now is below the price you purchased it at, then technically you have an unrealized loss. For example, if you purchased $100,000 of stocks in December of 2021 and it's worth $60,000 today, then technically you have an unrealized loss of $40,000 because your stocks are now worth $40,000 less than what you paid for them. And the same concept would apply if you bought crypto, real estate, or any asset that decreased in value. Now, here's the key. Unrealized losses do absolutely nothing for you, which is why they are unrealized. This means that you do not directly receive any tax benefits due to these investments losing value. And that is where tax loss harvesting comes into play. Tax loss harvesting occurs when you sell these investments to recognize the tax loss. You see, whenever you sell something, it creates a taxable event. If you don't sell it, it's no taxable event. And if you profit from the transaction, then technically you would have a capital gain. If you lose money on the transaction, meaning you sold it for less than what you purchased it for, then you would have a capital loss. So tax loss harvesting is the process of gathering up all of those losses in your portfolio, selling them to create the taxable event, and using the tax loss to offset your income. Now, of course, no one invests money to lose money. And that is far from what I'm suggesting. What we're trying to do here is take advantage of the fact that your investments are down in value. And by selling them, the IRS recognizes that loss, and then you can use the proceeds you receive from the sale to buy other investments. Now, we'll talk about this a little bit more later, but let me first make sure you understand the types of income you can offset with the tax losses that you create. So the first and most significant type of income you can offset are capital gains. Now, capital gains occur when you sell investments or assets and you make a profit. And you can offset 100% of your capital gains with capital losses. For example, let's say you sold some stocks in January of 2022 for a $10,000 profit. But let's say you sold some crypto at a $20,000 loss in June of 2022, resulting in a $20,000 loss. If that's the case, you will be able to use $10,000 of the $20,000 loss to offset 100% of your capital gains. So basically, your loss would completely wipe out your $10,000 gain, and you would pay zero taxes as a result. But now you still have $10,000 in losses remaining. Well, what happens with that? Well, let's move on to the second type of income you can offset, ordinary income. Now, ordinary income is income you earn from working. So this includes any business income, wages, salaries, tips, or commissions you earn from actively working for a business. So your capital losses can offset this type of income. But here's the thing, it is limited to only $3,000. So let's say you made $100,000 in ordinary income. Well, even though you have $10,000 in capital losses left, you can only use $3,000 to offset your income. So this is better than nothing, and this will result in you paying lower taxes. But what happens with the remaining $7,000 in losses you did not use here? Well, it rolls forward to future tax years. So any unused capital losses can be carried forward indefinitely. Now, this is big because you can essentially stack up tax losses to offset income for the rest of your life. And most people will have capital gains at some point in the future, whether it's from selling stocks, selling real estate, or selling their car, which is why many financial advisors look for tax loss harvesting opportunities on an annual basis for their clients. Anyway, like I mentioned earlier, you can offset 100% of your capital gains and also $3,000 of your ordinary income with capital losses. Now, with that said, let's go back to a point I made earlier about not investing to lose money. So like I said, no one invests their hard-earned money to lose it. And that is certainly not the point of tax loss harvesting. Investors invest to make money. But when those investments don't work out as planned, or maybe the market goes down entirely, then tax loss harvesting may be a great strategy to consider. But still, if you are a long-term investor, selling an investment might sound counterintuitive. Like, sure, you might recognize a loss and save a few dollars in taxes, but at the same time, you don't want to miss out on the potential upswing of the investment too, right? Look, I get it. And this is certainly something worth considering. But one thing you could do is consider selling your investments at the loss to save on taxes, and then immediately buying another investment with similar performance to what you sold, or an investment that you just think will increase in value. Take a look at this chart. These are two completely different investments, but their performance is very similar. So if you sold one of them while the investment was down in value and purchased the other, then you would recognize the loss on your tax return and still participate in the upswing of the investment as the market recovers. So effectively, you will not really lose any money. Now, the IRS is aware of strategies like this, so it is important that you understand a specific rule they put in place called wash sales. So if you sell an investment at a loss and buy the same exact investment within a 30-day time frame, then it is considered a wash sale. This means that your tax loss would be disallowed. Now, keep in mind, this is only if you buy the same exact investment within 30 days. The example I provided consisted of two different investments, but their overall performance was similar. So this would be okay as long as the investments are technically different from each other. Anyway, I know I just walked you through a lot. So let me give you the three main steps you need to take if you want to start using tax loss harvesting as a strategy. Number one, find losing positions in your portfolio. Number two, sell those losing positions to create a taxable event. In other words, a loss. And number three, use the tax loss to offset income on your return. Again, if you want to stay invested long term, you can use the proceeds from your sale to just invest into something else. If you enjoyed this video and you want my full framework to reduce your taxes by thousands, then click the link in my bio for a discount on my Tax Savers course at mycpacoach.com. As always, thank you for watching, and we look forward to seeing you in the next episode.